Hello and welcome to Budget 2013, The World View. I'm Harsha Subramaniam. In the next half hour, we'll tell you what the world expects from the Finance Minister. We've got a whole host of voices from across the world to tell you what Budget 2013 may have in store. From New York, Atsi Sheth of Moody's. From London, Bundeep Singh Rangar of IndusView. From Hong Kong, Chetan Ahya of Morgan Stanley. From Singapore, Robert Aspin of Standard Chartered. From Sydney, Richard Gibbs of Macquarie. Atsi Sheth, let's start this conversation with you. The Finance Minister seems extremely confident of achieving the budget deficit of 5.3%. What do you think is a realistic number? Do you think this is achievable?
You know, a few months ago, it looked like the 5.3 target was going to be difficult to achieve. And this was because of three reasons. One was that tax revenues were lower because growth was lower than anticipated. Two, subsidy burdens seemed fairly large and growing because of the prices of commodities as well as the devaluation of the rupee, or the depreciation of the rupee, I should say. And third, of course, is that the revenues from divestment, which have traditionally tended to miss the target, there was some uncertainty whether those revenues would come in as planned. As you mentioned, the numbers for December show that there has been significant tightening. All the three factors that I mentioned above were certainly true and still hold true, but the numbers for December show a surplus, which means that the government has really controlled expenditures. And I think this expenditure control will contribute to the budget deficit, if not coming exactly bang on target of 5.3, missing it by a very small amount. But I think it seems very clear from the signals that the Finance Ministry has sent that the 5.3% target is very important to them to meet and to satisfy investor expectations that the Finance Ministry is serious about fiscal consolidation.
Chetan Ahya, while fiscal consolidation will be the major focus of this budget, do you think this target is within reach, or will there be slippage in this number?
Yeah, we think more or less the deficit target is achievable now, considering the measures that the government has taken. One is to reduce subsidy, and secondly, if you see the expenditure item, which is excluding interest and subsidy, they have been able to cut that as well. In November, that item was down by about 2.7%. In December, it was down 5.8%. So the government is clearly moving in the direction to deliver on fiscal consolidation. We do think that there will be potentially some slippage to 5.3% deficit target, because it is quite a lot to aggressively manage this in such a short span of time, because the year is about to end. But it would be just about a minor slippage of maybe 0.2, 0.3% of GDP. And the government could report that 5.3% still by deferring the oil subsidy number into next financial year.
Bundeep Singh Rangar, while rating agencies are closely watching this number, how do you think the Finance Minister can get there?
I guess one of the key goals for the Finance Minister to make sure he doesn't have India lose its credit rating, because that's obviously under fire. And one of the concerns about there is getting this budget deficit over a certain period of time from north of 5% to at least sort of the 3% benchmark, and in the interim about a 4.5% to 5%. Now, what's really required here is, of course, cutting down some of the subsidies, and some of the things like fertilizer subsidies reduction will certainly help. But also at the same time, a key theme of this budget will have to be increasing foreign inflows, because unless you get capital inflows from overseas, you're not going to be able to reduce that current account deficit. So it's going to be a real pragmatic budget, and it should not be a populist budget. This is one where he's going to have to increase the tax base, rein in the subsidies, and increase capital inflows.
Richard Gibbs, pragmatic budget versus populist budget. Do you believe this 5.3% looks ambitious?
Well, the target is fairly ambitious, and it is looking like being breached, although the Finance Minister is denying that at this point in time. But if we look at year to date, we're heading very close to the target level as a percent of GDP, and it is going to be important that the budget delivers some meaningful steps to address the twin deficits. Not just the budget deficit, of course, it's the current account deficit, which is encountering increasingly hostile financing conditions.
Robert Aspin, let's talk about the current account deficit. The government has been trying to do its best to curtail gold imports. What, to your mind, the budget can do to curb the current account deficit?
Well, there's not a lot to do to fix it other than try and increase exports and perhaps also reduce the importation of gold. But the problem with increasing tariffs on gold imports is that you effectively have a large black market, which doesn't solve the problem. What I think they need to do is tackle both of these issues, both the budget deficit and also the current account deficit. And I think if they look to rational measures in terms of cutting back on gold imports, for example, and promoting export orientation, that should be to the benefit of their current account deficit going forward.
Sheth, how concerned are you about the CAD situation? What can Chidambaram do to fix this?
You know, I always caution against making too many medium-term either projections or analytical observations about the current account based on the specifics of the last year, which is when global growth was really, lower than Indian growth certainly, but also lower than had been anticipated earlier. So, not to draw too many structural conclusions about India's current account from recent data. However, having said that, it is true that India is energy dependent and will remain so. So imports of energy, especially if growth rebounds, are likely to actually increase, and the import bill will likely, oil import bill will likely increase. And secondly, the household preference for gold is also quite traditionally entrenched, and it's going to be hard for policy to really combat that in a significant way. So I think what policy could focus on is to create competitiveness in the economy so that export growth combats the import demand, and you have competitive exports. How can that be done? By reducing inflationary pressures and also combating some of the supply constraints in infrastructure.
Chaitanya, here there are inflationary consequences of a large current account. How do you think this CAD can be brought down? Are you expecting a significant reduction?
So one of the solutions to current account deficit would be to reduce gold imports, which has really shot up in a big way since credit crisis, because inflation or the consumer inflation expectations have been running quite high. So with government reducing its own expenditure, and we are also seeing moderation in rural wages, we expect CPI inflation to begin to go down from April. That will be a source of helping to reduce current account deficit, because that will help bring down gold imports in a sustainable manner. So that would be one. Secondly, the government spending reduction will cut consumption, and therefore that will also help reduce current account deficit further. So current account deficit will go down, but considering the fact that we are trying to revive investment at the same time, a significant reduction of current account deficit will be difficult, because investment rise itself will start to put some pressure again on current account deficit.
I'm going to take a break on that note. When we come back, we're going to talk about how can Budget 2013 get growth back on track. You're watching Budget 2013, the Worldview. Keep watching Bloomberg TV India. Welcome back. You're watching Budget 2013, the Worldview. Chaitanya here, let me begin with you, and I'm going to talk about growth. What can the finance minister do to get growth back on track? What do you think are the options?
Okay, in our framework, what we were addressing this issue as it's that what we've been going through in the last 4 years is bad growth mix. So even while we were continuing to have some meaningfully high level of growth rate, in the background we had persistently high inflation and widening current account deficit. So the bad growth mix had high fiscal deficit and low private investment. Now what the finance minister is trying to do is to first cut deficit, which will bring down the macro stability indicators such as inflation, current account deficit, and also help revive deposit growth. As we see evidence of that, the next stage has to be revival in investment. So we would say that yes, we would go through a period where growth is not exactly looking very good, but I would say the quality of growth is improving if you're cutting fiscal deficit. And the second stage is where, when we have finally all these macro stability in control, can we say the overall growth rates will improve with the capex. But this is a very different cycle. There is not going to be any V-shaped recovery. It will be a gradual recovery, as the process is quite complex.
Sheth, while the process may be complex, what do you think are the factors that have led to this decline in growth, and how can this be arrested?
I think that, if you look at Indian growth, there have been two factors driving the downturn. One is external, it's global growth, and this is obviously something that Indian policymakers can't do anything about. But the second is domestic, and this has to do with rising inflation, which makes production costs high, as well as higher interest rates, which are an outcome of rising inflation, and supply constraints in terms of infrastructure, as well as sort of sentiment within the investor community that the government was not helping them in terms of regulatory measures, etc. So the last three are certainly things that the finance ministry and other ministries within the government can address. The infrastructure gap, the regulatory gap, as well as measures that would contain inflation and hence allow interest rates to come down.
Richard Gibbs, growth is a key objective of this government, but if the finance minister is forced to cut back on expenditure, wouldn't that hurt growth even more?
Well, there we have a tension to start with. I agree with you, that should be a key objective, but if we also have an objective of fiscal consolidation, which we're all asking for in the budget, that means there is a tension between consolidating on the fiscal side, that is the government withdrawing income from the economy, and keeping growth in the economy. Other things being equal, you normally get a fiscal drag, as you know, which means that takes growth out of the economy. I think to try and maintain that growth, the government has to continue to pursue those microeconomic structural reforms on the production, distribution side, logistics and the like. It has to really work at reducing those supply side cost and price pressures that we're seeing in the economy. So really purchasing power, in particular on the part of households, continues to increase, and obviously the consumption and the private demand growth that goes with that should assist in keeping growth in the Indian economy.
Robert Aspin, given the problems that India is facing currently, what are the measures that need to be taken by the finance minister to move India back to the 7% plus GDP growth trajectory?
Well, I think there are probably two key measures here. The one is to continue with reform-orientated policies and to also make sure that those that have already been decided on by the Parliament are effectively carried through in terms of opening up the retail space to foreign investors. The second is also to push aggressively forward in terms of infrastructure development by pushing large-scale infrastructure projects forward. That will be to the benefit of cement players in the region, also the infrastructure and industrial names across the Indian market. So I think they need to go on those two fronts, infrastructure focus and also focus on maintaining the reforms and coming up with new reforms to increase foreign direct investment.
Bundeep Singh, Rangar, let's shift focus on investments. What can the finance minister do to make India a more attractive investment destination? What can he do to restore credibility?
What the finance minister really needs to do is to provide a certain measure of certainty. We know that the next election is still over a year away. It's 2014, so there's some time to put some measures into place. We know that with the credit rating of India under scrutiny, India is going to have to make itself to be seen as a safe and predictable haven. And there again, I think some of the issues of the past, whether it's corruption, whether it's retroactive tax application, certain issues involving large multinational corporations such as Cairn or Shell or similar Vodafone, of course, will have to be put in the past. And India has to kind of start with a clean slate. And this finance minister's budget is a real opportunity to say, look, the past is the past. Here's where we are. Let's have some more transparency and, more importantly, predictability.
Atsi Sheth, in 2012, we saw record FII inflows into the Indian equity markets. What do you think foreign investors want to hear that can sustain this level of inflows?
Well, foreign investors come to India clearly to make a profit on their investment. And as long as the Indian corporate sector remains competitive, profits will follow. So I think that is something that's the bottom line, that, flows come to India in search of profits, as they should. And anything that policy does that safeguards those profits, that propels those profits to even higher level, would obviously be something that investors would cheer in the budget. In terms of specific measures, policy certainty. There have been certain items that have been on the agenda, for instance, the goods and services tax, which is purely a fiscal measure, certainty around that. There have been other measures. GAR was one that was announced last year, and there has now been greater certainty about that. I think those are the kinds of things that investors are looking to hear more about during the budget.
Richard Gibbs, $24.5 billion of FII money has been quite impressive, but FDI is not so hot. Do you expect this liquidity tap to continue?
Well, I think what you really need to do is, and you're right, the inflow of capital from offshore was impressive, but the majority of that inflow is actually portfolio capital, which means it's highly mobile. What the government really needs to do now is lay the groundwork for a much larger proportion of that capital to be foreign direct investment. And that really is going to require further reform steps, further deregulation, making more attractive the foreign direct investment environment in India so that that capital actually remains sticky. So the investment comes in and it doesn't flow out again at the drop of a hat. That's been a major problem in managing the capital account and supporting the current account deficit. So really we need to see increased equity participation by foreign investors in the Indian economy.
On that note, I'm going to take another break. When we come back, we're going to discuss how can the finance minister revive the investment cycle. You're watching Budget 2013, the Worldview on Bloomberg TV India. Welcome back. You're watching Budget 2013, the Worldview. Chetana here. Let's talk about investment spending. A big area of concern has been the complete lack of investment spending. What can the finance minister do to revive the investment cycle?
I think the government can take up three key measures to revive investment. First is to strengthen the institutional processes where we are awarding contracts to the private sector. And this will help ensure that the process is done in a more sustainable manner. And we have seen some challenges related to that, particularly with the corruption scandals that we have gone through. The second is to ensure that in cases where there is not possible to do auctioning, for example, if it is environmental approval, then it's just that the respective ministry has to approve it. And if that can be done in a time-bound and a transparent manner, that will also be important to ensure that the capex recovers. And the third thing which could be potentially taken up in this budget is to provide some tax incentive to the corporate sector to do some capex.
Richard Gibbs, while the budget may not have all the answers, how can it really help in reviving the capex spending?
Well, really the budget's got to continue to lay the framework for a more fertile investment and business environment. And business continues to tell the government that we have major inefficiencies in relation to the infrastructure side of the economy. We have major production and supply bottlenecks in the economy. That's forcing up, obviously, not just the costs of production, but also in goods and services prices as well. So business needs a more efficient and effective investment and business environment. So business operating conditions have to be enhanced through government structural reform and those micro reform changes.
Robert Aspin, while reforms are necessary, how much does lowering interest rates influence the restarting of the investment cycle?
Well, perhaps not so much the budget, but what can they do generally in terms of policy? We take the view that with inflation coming off, and we target around 6% inflation by 2014, we take the view that interest rates, the benchmark rate, can effectively fall another 75 basis points. So they've already cut it by 25 basis points earlier this year. We're anticipating pretty much a 25 basis point cut per quarter, getting down to around 7% by the end of 2013. That, we think, will be one of the key measures to encourage policy or to encourage additional spending in the local market.
Atsi Sheth, let's talk about risk factors. What could be the potential negatives in this budget?
I think I'll speak purely from a credit perspective, and this is an observation we've made in the past, that India's credit profile is really constrained by the level of its deficits. India's deficits are far higher than those in other Baa3 rated countries. India's debt ratio is far higher than those in other Baa3 rated countries. So anything that shows that the government is complacent about the level of deficit and debt would be credit negative from our perspective, because even if the 5.3% target is met, it is still far higher than those in other countries. So it's not just the 5.3% target; it's the roadmap for the target beyond over the next 3 to 5 years, insofar as this finance minister can project that far. That we're looking at. That this is something that a lesson has been learned, that fiscal consolidation, the lack of it, has implications for the macroeconomy. It does feed inflation. It does bring down investment. And this is hopefully a lesson that will bring the fiscal position back on track.
Bundeep Singh, Rangar, last time we had quite a few red flags. GAR, retrospective taxation. What do you think the FM should not do in this budget?
Well, there's a few things that we don't want to hear from him about. One, we don't want him to put any fear factors in the market that get capital markets to shudder. We also want to make sure that he doesn't create a false economy. Look at India's gold imports. India's gold imports have, on paper, gone down in the past year between 2012 and 2011. But the word on the street is that the informal imports, or in other words, illegal imports, now constitute 25% of India's gold imports. So if you find ways that are too on paper clever, they'll just find, the market will find ways to circumvent them. The second thing, of course, is you don't want to put any scary tax situations on foreign company investments into India, because that again will create this mood of apprehension for foreign investors to come into India. And lastly, and not the least, even though I think that, it's not a populist budget, I do believe that to some degree, keeping the masses and keeping the flow of financial upliftment going down to the core of India's economy, which is agricultural, is going to be really important, because you don't want to get social unrest by means of over taxation of either the farmers or certainly people who support the middle and lower ends of the economy.
Richard Gibbs, to your mind, what are the red flags that a global investor needs to watch out for?
Well, they really won't want to see any kind of retrospective rollback of investment incentives, of course. They will certainly be looking very closely at any sign of re-regulation in key sectors, including financial services, of course. To the extent that they see that, that will be a major disincentive. Interestingly, on the tax side, business really and foreign investors want to see the progress with the goods and services tax. The tax base does need to be broadened. The indirect tax base in India needs to be broadened. I don't think anyone really is asking or wanting to see an increase in the direct tax base. When that happens, when direct tax rates are increased, we see compliance really decline and deteriorate significantly. So we need to see a rolling out of that goods and services tax sooner rather than later.
Last word with you, Robert Aspin. What is it that you don't want to hear from the Finance Minister in Budget 2013?
The opposite of everything I've just been talking about previously. I think what foreign investors don't want to hear is a focus on populist policies, shall we say, in terms of, for example, increasing the minimum tax rate or the minimum threshold for taxes, or increasing, for example, the minimum monthly wage or daily wage or hourly wage in that matter. So basically focus on reform-orientated policies, focus on infrastructure rollout, focus on opening up the economy to foreign direct investment. That's what they want to hear, and the reverse of that is what they don't want to hear, which is focusing on appeasing the local communities and so forth. I think that's the key issue. And then coming back to focusing on the deficit and also ensuring that inflation is under control. So yes, we do anticipate inflation will come off, but we don't want the central bank to reduce rates so far that inflation again becomes an issue.
On that note, ladies and gentlemen, many thanks for joining us on this special program. Let's wait and watch what the Finance Minister has in store in Budget 2013.